Hey, Christian, how are you?
I'm doing fantastic, Dahlia. Thanks for having me on today.
My pleasure, and thank you so much for joining us today. Christian, you run and established a real estate company called Alifris. Would love to share a little bit about you as an investor and your experience with the audience here before we talk about how to adapt and thrive in the new real estate environment.
Sure. Yeah, so I've been investing for in total, about 17 years in any serious capacity. And then I became a full-time real estate investor, as I call it, a professional real estate investor. In 2017, I left my corporate job at the time and doubled down to work on full-time real estate investing. And we structured a really strong business from there. We invest, I'd say about 70% of our assets are in commercial residential. And then we also have some holdings in light industrial, some office, some retail as well.
Fantastic. And in this environment you're in, and in this environment that we're in, given your portfolio, what are you doing differently compared to the past 17 years, given that the rates are rising and the prices are changing a little bit? What are you doing differently today and stepping into this new environment as an investor?
That's an interesting question, right? And I'm tempted to say that I'm not doing anything differently, really, because I have a methodology when I take a look at acquisitions. I don't really care too much about market cycles in the sense that I have business criteria that allows me to make decisions on whether I'm doing an acquisition or the form of projects that I do. So, that may be a little bit glib, right? In reality, if we look at it on a micro basis, as opposed to my longer term strategic basis, I'm making some fine tune adjustments to parts of the portfolio. But when I do an acquisition, always the first question in my mind is trying to figure out, okay, can I have this product, this asset, cash flow on acquisition? Or do I have a project that gives me line of sight to cash flow? And I'm rigorous about that. The only exceptions that I might make to that, or where I'm buying some strategic land, so some land banking for future development projects, that's more opportunistic than anything else. But fundamentally, I focus on figuring out how I'm going to get cash flow out of a particular asset right off the beginning, or after I do execute on a business case for a project.
Okay, so you've always got the cash flow mentality, and that's been your a big criteria when looking at an asset to acquire, is what I'm hearing.
Yeah.
In a rising rate environment, I assume you have some variable rate mortgages in your portfolio, correct?
Mm-hmm. Yeah.
Okay. In a rising rate environment, depending on the product you're on, whether it's a capped variable or a floating variable, there may be an impact on cash flow. How are you looking at that as an investor? Are you, again, doing anything to manage the reduction in cash flow, or is your portfolio strong enough so that in other areas is still cash flowing strongly, that it's offsetting some of the reduction in cash flow on other assets? What's that looking like?
It's a really good question. So I'll start with something a bit more fundamental, I guess. Is I kind of look at, fixed rates and variable rates are very, very similar. It's just, one matures at the rate of the Bank of Canada announcements, and the other matures on a 4 or 5 year term.
That's a nice way of putting it.
And so sometimes my fixed rates are just maturing, and I've got 3 refis coming up this year in this particular type of environment. So you just kind of have to roll with it. But what I do is I have about 70% of my debt in some sort of a fixed product. And I know that I'm paying more than if it was in a variable, but I kind of look at it in very simple terms. I need predictable cash flow. I need predictability in my operations, because if I get a reduction, and remember, I'm running an investment business. So if I get a reduction in my cash flow, that impacts, who I can hire, for example, and the speed by which I can build new product or redevelop product. So I kind of view fixed rates typically as an insurance product above a variable rate. And sometimes that premium is cheap and sometimes the premium is expensive.
Mm-hmm.
And so when the premium is cheap, I don't have a problem going into a fixed product, and therefore I have absolute predictability around the cash flow of a particular asset for the future. So, and in that period of time, that allows me to execute on a business plan that says I'm going to increase the net operating income of that particular asset. So when I take on an asset, I don't just let it ride. Okay, I try and figure out how I'm going to expand the net operating income, or the NOI. And if I can expand the NOI, make it bigger, then that necessarily generates a contingency, if you will, that allows for fluctuating rates, et cetera, and without having to give up a whole lot on my cash flow. And when you're taking a look at the NOI expansion, right, there's two parameters. You can either increase the revenue or you can decrease the costs. And it is far, far easier to generate more revenue than it is to reduce costs. So we always figure out what new revenue can we generate at a top line basis in order to help mitigate those risks.
So what are some of the ideas you can share with listeners about how to generate revenue within your portfolio?
Right. So there's the classic ones. So for example, if you've acquired an asset that is largely under rent, then there's the obvious rent increase that you can do as tenants turn over. And I'll be clear, I don't force tenants out. I just don't do that. So as tenants turn over, that's an easy one to do. But there's other opportunities that you can do. You can add additional services for particular assets. So for example, we resell internet, or we'll add storage facilities, or we will add additional parking capabilities, or we will have I'm just trying to think of some other clever stuff that we've done recently. On some of our residential products, we've gone to medium-term rentals on some of the units. So furnished apartments, for example, on a residential side, or something that we did during COVID, which was, of course, another unprecedented and unusual time, is we have office space. And that office space, what happened there, obviously, is that we had some tenants vacate through there because their leases had come to an end, and releasing was difficult. So instead, what we did was created smaller offices for people to escape the house and be able to go to a temporary work environment. The advantage that happened there is we got 50% more revenue per square foot by doing that. So by, aside from the amenities you can add, so we've also done things like cleaning services and laundry services for people. So taking some of the benefits we get from short-term rentals. But if you take a look at, say, a medium-term rental, you do furnished apartments, those often have a higher lift than a standard long-term rental. Or by going to taking larger 3-bedroom units and cutting them up to create 2 1-bedroom units, you can get a 50% increase in revenue per square foot. So there's a bunch of things we're constantly adapting, and that's absolutely key. And it's not just when interest rates are going up, but we also have to think strategically about how can I change the dynamics of that particular asset in order to generate a better return. And when you really think it through, and I just came up with a bunch of ideas right there, there's a lot of different ways that we can do that and move the needle on the revenue line.
I love that. You're looking at opportunities to increase your top line revenue, and you're coming up with ideas to do so. On the debt side, before we got on this call, you're telling me about re-amortizing some mortgages at some point to increase cash flow. Do you think that is a viable option in an environment we're in, where some clients that may not have an opportunity to add revenue to their portfolio, that they can tap into things like re-amortizing existing debts to help with the cash flow? Is that something you've done in the past, correct?
Yeah, absolutely. It's definitely an option, right? And obviously there are restrictions when you're within a particular debt product, right? Sometimes you can't just do it mid-term.
Yeah.
But one thing that you can do often is that you can change things in order to effectively build a reserve. So if you're in single family homes, for example, you could put some sort of HELOC in place on top of the mortgage in order to be able to generate a contingency fund. You don't necessarily need to draw on it now, and it may even be a readvanceable mortgage where the principal pay down becomes available to you quite quickly. Yes. And that becomes a reserve fund. But the way that I typically do it, say on the commercial side, is that when I do refinances, I typically try and have as long an amortization period as possible. Now, the one pitfall with that is you're not doing a lot of principal pay down. And if you're not generating, new value in the property, that can become an exposure. So what we do instead is that when we take that longer amortization, we take what would have been the principal on a shorter amortization and we build a reserve fund. And on that reserve fund, once it's built up to enough, then we'll use the excess cash flow from operations or for operations. So by building a reserve fund in either way, either through a HELOC or readvanceable mortgage, or doing it in the way that I was just describing with a longer amortization, the reserve fund is what you need to weather the storm. So even if you get into a negative cash flow situation for a short period of time, you can pull on the reserve fund in order to be able to pull you through the storm, if you will.
I love that. And the line of credits and advanceable mortgages are very strategic products to use. I remember when COVID hit and clients were concerned about their roles with their companies, or the fact that they're going to have vacancies or tenants not paying. In many cases, we've lined up secured line of credits that helped clients weather through the storm, because it was a reserve, and in some cases, interest only loan versus an amortized loan was easier on the pocket. So I can really relate to what you just shared. Yeah. Christian, you're always calm and very methodical and collected, and I love that about you. And again, we're in an environment where the media is sharing big words and big headlines and causing an anxiety, and some investors are scared. Why aren't you panicking right now?
I don't, because of the approach that I take, and I'm going to share this with your listeners because I think it's important. There's kind of two things here. One that I borrow from the military, and it's basically slow is smooth, smooth is fast. Right. And just to reinterpret what that means is take your time, think through the problem. Don't rush, don't make mistakes. Okay. Take the time to think it through, get the right action plan in place, and then executing on that action plan. You'll be surprised at how quickly that actually happens versus just panicking, right? And I was going to show you this as well, right? But this is our little model.
That's a perfect cup to be drinking from right now.
That's right. Yeah, it's my tea mug. But then there's one other thing that's really important. So if you're worried, if you're panicking, this is the right time. I mean, always you want to do this anyway, is risk management. Okay, there's a risk management process. But if you're panicking, it's because you haven't done your risk management. And so really very simply what I would do, if you feel uneasy, if you're not sure, and you might, I don't think anybody's in their outright panic, but I think they're worried. So yes, start to make a list. of all the things that you're worried about happening. Then try to figure out next, what's the probability of that happening? Then try to figure out what's the severity of that happening. Okay, so we'll start with that. So if you have a particular risk, and let's say it is high severity, right? It's going to be a real problem, and the probability is very high. Okay, you need to put a plan in place. It needs to be part of your baseline plan, get it done. If you have a risk that has low probability and low severity, don't worry about it.
Mm-hmm.
Okay.
But at least you put some parameters and defined what that looks like. It's not the big monster that is sitting in the head, right?
Exactly.
Yeah.
And then there's this middle ground, right, in between those, where there's particular risks that you may not have to plan, but you have to be concerned because it might happen. It's reasonable high probability. And if it were to hit, it would be at least a medium to high severity. So then you don't have to plan for it and build it into your plan right now, but you do need to prepare contingency. So you need to start to ask, okay, if this were to happen, what will I do? What's my backup plan? What's plan B? What's plan C? And I do actually go to plan B and plan C, right, on my contingency plan. When you have that all written down, calmness will return to your life because you know what you're going to do in those eventualities. And if conditions change again, then you reevaluate your risk management plan and figure out what you might need to change. And I'll tell you, by doing that, I sleep very well at night, right? Even when conditions start shifting like this, even when COVID happened, even when this was happening. You know.
I love that. How often do you do it? How often do you sit down and assess risk and quantify using the method you shared with us, what the risks look like and have a plan in place? How often do you do that for your business?
So at various part of our cycle, so I have an annual process that I do. I have a strategic plan that I update. I have my annual operating plan that I update and my risk management plan for the business. But then on individual projects, I will do the same thing. I'll have a business case and I'll have a risk management plan. And then typically after that, I just do a cursory quarterly review on those plans to see whether or not we're tracking on that. And I will also do it whenever there are significant changes. So for example, bond rates or bond yields have been going up significantly over the last quarter or the last 3 months.
Yeah. So
that prompts me to go back, reevaluate some of my existing business cases and make sure they're still sound, right? And thinking about my risk management plan with it. So I do it on demand, and quite frankly, I'll do it anytime that I get a, cumulative case of the willies, right? so if I'm sitting there, lying in bed and thinking, oh, I'm starting to get worried about this, that, or the other thing, the next morning, I'm going to start working on my risk management plan, right? Just to calm myself down.
Love it. Love it. But like you touch on several key points here. Look at opportunities to increase revenue. And I think sometimes we surprise ourselves with what we can come up with when we really get in creative mode of problem solving. And then 2, there are opportunities on the debt side. We talked about secured line of credits. We talked about advanceable mortgages, maybe reamortizing in some cases. You talked about contingency. And even lining up some of these things to have contingency. And then lastly, a proactive risk management would bring calmness and better sleep at night. And then I would add the 5th one. Can you show us that cup again, Christian?
Sure.
We're all buying that cup from Christian. We're going to buy a supply of these cups. That's the 5th strategy, guys.
Order more cups.
Yes. Well, thank you very much for these tips. Is there any last thought you want to leave the audience with from an opportunity standpoint? Like, do you see the market ahead as an opportunity, or do you see it as a market where we should sit and wait to see what happens?
I'll go back to what I said at the beginning, which is that I have a methodology for buying. So I bought stuff even in, you know, the so-called crazy market that we've had over the last 2 years, and I've bought them they were immediately accretive to my portfolio, right? So I've added cash flow to my portfolio even in the hot market that we had. But as we go forward, and let's be perfectly honest, the fact that we're asking a question about panic says that there's going to be a lot of naive people that are going to panic. And even though they don't need to panic, the first reaction, just like that happens in the stock market, is they start dumping stuff. So they buy high and sell low. And so those of us that are clever, that have a methodology about how we're going to acquire, are going to watch for those particular opportunities. So the people that are panicking are the ones that are going to lose out. And as long as you stay calm, right, and invest in real estate, you're going to be able to pick up those assets as they come out. So
fantastic. And can you repeat the military saying, the code that you shared with us earlier to wrap up?
Absolutely, and that's probably the key takeaway for people, right? To stay calm is slow is smooth, smooth is fast.
Slow is smooth, and smooth is fast.
That's right.
I love it.
Yeah, and if it works for the military, it'll work for us.
Absolutely. Love that quote. And thank you so much for your time and for the insights you shared with us today. Really appreciate it.
Welcome.
Thank
Very
you.
welcome.
Okay. Take care.